The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio and our series of live episodes from this year's Futures Industry Expo in Chicago. And we have a couple of old friends of the show coming on right now. We are joined by Phil Gocke, the Managing Director of Institutions over at the OIC. Phil, welcome back to the show.
Thank you very much for having me.
We're also joined by Eric Kott, who is the Director of Financial Advisor Education over at the OIC. Eric, welcome back to the show as well.
Mark, thanks for having us.
And Phil, we're going to dive right in with you. Our listeners won't know this, but we actually have an infamous lost episode with Phil from about a month ago. We brought Phil on from his home in Philly there, and for some reason, Ma Bell just did not want to cooperate, and the audio was lost in the ether. But we have a chance to bring him on in person, which is far more fun because now I get to stare at him across the table, which just makes my day. And Phil, I want to give you a chance to, well, first off, I know you've been on the show a bunch of times, but we'll do a quick hit again for the new people listening to the show, what the Managing Director of Institutions does at the OIC.
Primarily, I work to provide education to pension funds, endowments, foundations, hedge funds. And that education generally comes through relationships we have with academic institutions that do studies looking at various option strategies for risk management and yield enhancement. And we then promote those studies on our website, optionseducation.org/institution for us. And so all our studies are available free and for download. And of course, because we're an educational organization, our goal is not just to promote options, but to talk about when different strategies work as well as not work. That is an integral part of our mission.
And one of the reasons we like to have you on the show is you always bring interesting goodies for our listeners. And when we had you on last time, we got into the Tower Group study quite a bit and some of the details on that. And I know you also have the Collar study to update and a lot of other studies we can get into. So let's get right into the Tower Group study because that's some fascinating stuff for our listeners. I think they'll be surprised with some of the findings that you discovered there.
Well, it's a great day to be able to sit across the table from you.
Any day is a good day for that.
Well, that's true. That's true. But, of course, we've had a lot to look forward to that is coming to fruition. The national elections, new Fed actions on quantitative easing. We're approaching the year end. We finished the earnings studies. And, of course, one of the things we're finding is we continue to have high levels of uncertainty and volatility in the financial markets. The Tower Group study, which we released, in early September, surveyed a group of 30 pension plan sponsors and money managers to investigate whether they are comfortable with using options as a risk management and a yield-enhancing strategy. And as it turns out, and somewhat stunningly, the institutional group, which heretofore had reticence for using these products, they saw it as headline risk, it had a bad connotation, have gone completely the other way since the financial crisis hit in 2008 and bottomed in 2009.
Yeah, that's pretty much the opposite of what you would have initially assumed from that audience. Particularly, they are very risk averse and derivatives averse group.
And as you said, derivatives certainly didn't come out of that as with a good name, in the credit default swaps, and a number of interest rate areas. But as it turns out, the equity options, index options, were flawless in their performance of providing liquidity, providing transparency. And as it turned out, since all assets correlated to one and went down, other than possibly gold and long U.S. government bonds, the reticence that normally would have occurred has been completely changed. They now recognize, these institutions recognize, and the survey confirms it, that derivatives on equity options and index options were one of the few ways they could have protected themselves on the downside and avoided 20, 30, 40, 50% losses. And amazingly, we have now seen that they are embracing downside puts for protection and handling tail risk. We have seen volumes which never before were able to be maintained in the derivative markets when there's a major market decline. We actually grew our volume. And why? Because the institutions were accepting this as a new tool. And the survey, which is very specifically, as I said, it's available on the website, the survey really said a vast majority of them saw the use of options as one of the few ways they could have protected on the downside.
It's got to be gratifying for someone like you. I know you've been pounding the pavement at the institutions for the OIC for a few years now. Sometimes the response, I know in past years, has been whenever you mention the derivatives word or the options word, the response is probably, whoa, what are you doing, or less than favorable. So to hear that these institutions are picking up and embracing the product on their own accord in light of all the things that have happened, it's got to be pretty gratifying for a guy like you.
Well, it is, and actually, Mark, we give you full credit because it's
as well you should.
It's your efforts to provide this education to your listeners that has made the difference, and it is gratifying, and it has changed. I think both what Eric and I have been doing. We're no longer fighting the fight of please let us talk to you. We're fighting the fight of we can't fit in our schedules enough meetings because they're desperately looking for education. There is still a need for education. They recognize that derivatives and options tailside risk management was worthwhile. Many of them don't know how to do it. They're not comfortable with executing overlay strategies. And therefore, they've gone to different money managers who have that expertise, which makes a lot of sense.
Yes.
But the boards still need to know more, and we're spending all our time, both on the institutional side and the advisory side, providing that education to now a willing audience. It's really quite phenomenal.
You don't have to grab them kicking and screaming and force them into the chair to listen. That makes your job a lot easier.
It is cool. It is cool. So let me, if I can, let me weave the other part of what I wanted to talk about.
Sure.
As you know, we talked about a collar study. This is a modified collar study that was released last year.
And we love the collar study on our site.
That modified collar entails buying a 6-month put and writing consecutive 1-month calls. And the data ended last May of 2009. There has been a great deal of interest to know how did that strategy perform as a risk management tool through the entire period of the financial crisis beginning in 2007. So our friends at the University of Massachusetts have updated that study, and now we have data through September 30th of 2010, and it continues to show that over that 11.5-year period, had you used this collar, instead of losing 1 or 2% over 11.5 years, the lost decade plus for the NASDAQ 100 index, you could have made 110% using a passive strategy. Simply continuing to buy a 6-month put and write consecutive 1-month calls, always having downside protection. And it's a pretty dramatic shift.
That's amazing. I continue to bring up the collar study all the time at various venues and events and on the different shows that we do. And people are always amazed to hear not just that the collar study outperforms on a risk-adjusted basis, which some people would probably assume, but it's actually competitive, if not outperforms, on a pure return basis, which is phenomenal. That really, I think, when people hear that really their jaws drop, their eyes open, and they start thinking of collars in a different way. The collars have always been the traditional downside thing you do, or the strategy you do when you don't want to pay that much for the downside, and it's always primarily defensive, and it never can really compete against a pure long strategy. And this study and the way you've structured that collar shows that it can be done.
Can be done, and did accomplish the objective. So, having just talked about the 11.5-year period, the 3-year period, starting from September 2007 through early October 2010, during that entire period, including a very rapid recovery in the markets after March of 2009, once again, if you were long naked, the NASDAQ 100, you made about 2%. If you were long the passive collar strategy, you were making on an annual basis just about 4.25%, almost 13% cumulatively over the whole period, with volatility being 1/3 of the level of being naked long the NASDAQ. NASDAQ standard deviation is 26. The collar was only 10% for that period.
That's amazing. And I refresh my memory quickly on the different types. The passive strategy was a 6-month put with the at-the-money call. They kept writing every month.
Correct.
And then the active was they adjust the strike of the call every month, correct?
Using a combination of models, fundamentals, using unemployment, technicals, using moving averages, and volatility using VIX. So with those 3 components, the model had rules, so it wasn't like you were arbitrarily making the changes, but those rules then allowed you to modify what strike price on the call you were writing. And I should then go to the last issue, because we are an educational organization. Even in the environment that began after the market bottomed, volatility for that strategy, both active and passive, were better than the underlying. But understand, if during that period, starting in mid-2009, you were better off being naked long NASDAQ. If you picked the bottom,
yes,
no matter what you did with writing the calls, it limited your gains. NASDAQ for that roughly 12-month period, 14-month period, rose almost 30% per annum. The passive collar was only up 12. Again, volatility was 1/3 the level, but if you can pick the bottom,
then you don't need collars.
You may not want to protect on the downside. But our objective is to look at strategies where you don't have to be clairvoyant, and you can then modify things if you wish. But if you never did, you're getting a better performance with lower variability across the board.
Particularly for your audience, the institutional, and for Eric, the advisor audience, they want, I think, a little more hands-off type of strategy. They don't need to be able to pick the bottom. They want to look at the average scenario, which the collar will outperform for them. Of course, if it's an explosive bull market, it probably will underperform. But yeah, I think for most of them, they want a little more hands-off, a little strategy. They can kind of do the passive strategy, show that in and of itself, without having to manage the call on a regular monthly basis, is competitive.
And we're thrilled to have our partners at the University of Massachusetts. Again, the study and this appendix, which updates the data, will be on our website, optionseducation.org/institutions. And I should say now, while I focus on the institutional use of this, the strategies are completely applicable for retail investors and financial advisors. And maybe Eric can talk a little bit about how they might use it. But in effect, we all have the same problem. Our portfolios got devastated in 2008 and 2009. What could we have done? And it's just as valid for a financial advisor than it is for a pension plan, endowment foundation, or a hedge fund.
Phil's absolutely right. The compelling thing for the advisors right now is, number one, that Phil has worked with the University of Massachusetts, updated the data. We're coming from a very established university, along with OIC putting forth the research. For advisors right now, they're used to using collars when they talk to corporate executives. So that's kind of, they've seen some times where they've worked with corporate executives in collars, and the client hasn't been happy because the market's gone up, and unfortunately it wasn't, exactly what they wanted. Yeah. But, look, Phil has laid the groundwork, and thankfully from my vantage point now, working with advisors, we're able to sort of cross-pollinate, the institutional marketplace along with financial advisors. So I've been fortunate enough to have Phil out with me in the field at some of these events and speaking to the advisors. The interesting thing is that we're definitely seeing an increase in activity. As Phil had mentioned, the advisor who went through the debacle of '08. I mean, again, we talk about derivatives. Advisors look at options and think about Bernie Madoff, and I have to get them away from that, and then also get them to the point that, look, we've seen record volume in 2008 and 2009, and it's not all coming from institutions. It's coming from their clients. There's been a lot of changes in the marketplace. For example, we were 7 exchanges. We're now 9. We're soon going to be 10. We've had the symbology change that went on this year. All of those have added to the ease of advisors using options, but feeling comfortable talking to their clients.
So you are seeing, that was going to be my next question then, so you are seeing the same uptick in interest that Phil's seeing on the institutional side, on the advisor side, because like institutions notoriously risk averse, financial advisors also notoriously risk averse, also notoriously derivatives averse. Like you said, they hear the headline making scandals, and that tends to paint the entire picture for them. So you're seeing a strong uptick in interest as well then.
Absolutely. In the last couple of years, I mean, as I said, Phil has paved the way along with his colleague Joe Burgoyne, and now from the advisor standpoint, we're seeing not only at conferences, we're finding a lot of investment firms are calling us to come out and speak to their advisors. We're forming content sharing agreements where they're taking our material, which, again, you always promote very well, Mark, but they're looking at our material, and I think it's wonderful in an environment like today where an investment firm and senior management could say, OIC is going to provide the chassis. We've already built it. All the content, whether it's research that we've done or online exams that advisors can take to get comfortable, and we're not going to charge them for it. So they almost second guess us.
Yeah,
wait a second, you're gonna give us all this material, and all we need to do is acknowledge OIC is providing it. So it's wonderful, and again, we can't keep up with the demand. I echo Phil's comments. We don't have at times enough manpower to be at the conferences, be at the firms, but it's a good problem to have.
Yes. I've often said, you've been on the show in the past, that I don't envy your job. The financial advisors, I call them the holy grail of the options market because they represent such a vast, untapped reserve of resources and assets that, quite frankly, match up very well with options on paper. These are primarily long-only managers. They should be writing calls and buying puts and doing collars, and yet 99.9% of them just don't for a variety of reasons that are probably too long to list here. And, as we see the audience for our, the Options Insider and the Options Alliance growing and exploring in different ways, we traditionally thought of the options market as being 3 pillars. You have your basic retail, you have your high-end retail, and you have institutional. And now we're adding a 4th pillar to that mix now, which is the financial advisor. Just judging from the traffic we're seeing, the requests and information requests we receive, a larger and larger percentage of that is coming from that financial advisor community, which is, quite frankly, a good thing, because that's something we've tried on our own ways, and OIC and other groups have tried for years to try to penetrate that market and to see that it's actually finally taking root, and I'm sure that's all due to your many efforts on our behalf. But that's definitely something that's good to see. And like I said, that is the new pillar of the options market, is the financial advisor.
Well, I'll say, Mark, I probably commented on this on your show before. The debacle of '08 opened the eyes of advisors, where they sat in this deer-in-the-headlight syndrome for about 6 months before the market bottomed in '09. And so now they're looking for opportunities where they could talk to their clients, and that's the beauty of options. So if they're in a zero interest rate environment like we're in right now, they're looking at long positions in the portfolio with the client, why not at least have the dialogue of doing a covered call? And if they're worried about volatility, they're worried about after the election and the market's going to go in a different direction, we don't know what's going to happen with taxes, then maybe they start to do an overlay with protective puts. And then, again, we go back to the study and we start to focus on the affluent client base that these clients have and say it's appropriate to start looking at the collar.
Once you get the advisor past the initial hurdle of embracing options and being willing to discuss the topic, which is not an insignificant hurdle by any means. Once you get past that hurdle, it seems the second question then seems to be, well, I have all these diverse accounts with diverse assets. Like we talked about before, the collar study, I don't want to pick my strikes every month and roll my collars, or I'd have too many accounts to do all this stuff in. It seems to be more of a time management question where they don't maybe have the time to be able to effectively implement all these strategies. So I'm sure you get that question a lot. What do you recommend to the advisors who ask you that? I mean, do you say, hey, go for the buy right index, or what kind of hands-off type strategies do you recommend for them?
What I usually discuss with advisors when I'm out in the field, and I've mentioned this to the roundtable of the OIC as well, most advisors are used to sub-advising out any type of portfolio management because, again, the focus for most advisors is on their client base and growing that. So we're seeing a lot more ETF firms that are offering option strategies, overlay strategies in an ETF format, or there are mutual funds that are out there. There are separately managed accounts. So for the advisor and you're absolutely correct, I think that's one of the largest hurdles we have to overcome is an advisor says, it's management. I'm a single proprietor, I don't have a team, and how do I maintain, looking at, all these different portfolios with different contracts, different strike prices. I might be out on the golf course with my client and all of a sudden, I get early expiration and then my client is unhappy. I'm unhappy. I'm not going to go back to look at options. So I think that the growth we're seeing with a lot of ETF providers and, again, other asset managers offering the strategy so the advisor can turn over the day-to-day management and still provide something very competitive to their clients.
Yes.
So you're right. The two obstacles are, number one, that they look at it as a derivative, and we have to get them over that
just
hurdle.
forget the D word altogether.
Forget the D word. And then to talk about maintenance, where, again, one of the things that we're most proud of also at OIC is, we have a virtual trader on there, which advisors can go in, download a client's portfolio, and almost practice how it would turn out rather than committing real money. So that at least gives an advisor the opportunity to sort of see how it would play out, doing a certain strategy with a client's portfolio. And we're constantly, again, offering different opportunities for advisors to talk to the clients in more layman's terms. I think they're very overwhelmed at times, advisors, because they look at this as a very complex instrument.
Yes.
When you sort of drill it down and you look at providing analogies, I think it's an easy way to talk to their clients.
Now, one of the other things I wanted to ask you about is I know you just launched the advisor website about a year and a half, 2 years ago, and I know you're in the process of redesigning it. There were quite a few landing pages, sometimes in registration pages, in the way of actually getting to some of the content there. So what's the status of that redesign? How's that progressing?
It's progressing, and we're moving towards that goal. I would say along those lines, as you talked about the original date of the launch of the FA site, one of the things that we just relaunched was the partnership we have with the Rutgers School of Business, which we're very proud of. OIC formed a partnership with them about a year and a half ago, and we figured out what was, in essence, the holy grail for us was putting it online. We have 3 different classes. I sort of refer to as the right lane, middle lane, left lane. Those are continuing ed credits for accredited advisors to go on, and they can learn about options in different format. And we have now seen incredible success with that. We've had overwhelming registration to that, and we'll continue to add new programs going into 2011. So more to follow on the web redesign.
That's always the answer with any website redesign thing. It's in progress. I know from experience that's a bitter process. But I agree that is definitely one of the, what you mentioned with the continuing education is definitely a key, because advisors, they don't learn about it usually in their exam, so they need that education. And also, there's a marketing aspect for them as well. They can have a shingle or something they can put up there and say, I took this class, I'm certified in options or covered calls or whatever the certification may be. There's a value added for them as well. So they get the education and they get to say to their clients, I am X certified, whereas these other advisors in the area aren't. And so it adds business to them. It's accretive to them in the long run. So I think that approach is definitely a good way to go.
Well, there's a lot going on in Washington right now about potentially looking at overhauling the whole registration of financial advisors and registered investment advisors. So I think we're at the forefront of providing this continuing education, which, as you said, provides an advisor that opportunity to then show to their clients that they've gone the extra step.
Yes.
And now providing them something that's different from the advisor down the street.
Exactly. And Phil, I can see you chomping at the bit over here with many more studies to regale us with. So what else do you have in your pile of papers there, sir?
Well, actually, the Tower study, and I think Eric would echo this from the financial advisor, uncovered not only the need for downside risk, but of late, with interest rates being at virtually zero, and maybe that way for some time, increasing yields and yield enhancement strategies have clearly become more popular. In that regard, we also updated a buy right study on the Russell 2000 that we had originally released about 3 years ago. So we now, again, that'll be on our website as well. We have now updated that data through September 30th. And buy rights are pretty straightforward. In some ways, it's incredible they're not used all the time. Virtually every study echoes the same issue. You'll get the same rate of return, if not slightly better, than whatever the underlying is, whether it's SPY, SPX, or Russell, or NASDAQ. But you will get it with a significant reduction in volatility of earnings. Again, our focus here was to talk about what happens if you did a buy right during the credit crisis from 2007 to 2010. And yes, indeed, once again, you had a situation where you would have avoided a loss had you been long the Russell 2000. You would have gained almost 3%, 2 to 3%, depending on your strike price, instead of losing money during that period by being naked long the Russell. And again, you would have done it with a third lower volatility. The two parts of, or the two desires from institutional as well as financial advisors and retail is they need a downside protection and need yield enhancement. And frankly, the two best ways to do that is to be talking about buy writing and talking about collars. And if we can keep focusing with your help, how does the user accomplish his objectives instead of wasting time on talking about complicated definitions and Black-Scholes models? What's your goal? You want more income? We've got a way to deal with it. If you want to protect on the downside, this tail risk is really an issue. We've got ways for you to manage it. We can really, bring this to fruition and get a permanent reduction in the pain that we have experienced recently. And as you know, it's amazing to me that really, how could we have forgotten? It's only been, between the bottom of the tech bubble was 2002 and the top of the markets before the financial crisis was only 6 years.
Yes.
We didn't remember that long. And amazingly, when the Dow broke 11,000 in early 2010, immediately people stopped worrying until the flash crash. That event just raised the whole issue of, financial market risk and the need for, risk management. And I hope, that we won't forget the message again as we go forward. If we get lucky enough to rally to new highs, invariably highs cause people to stop worrying about risk management. But that's our message, and we continue to hope to be able to make it successful.
Very well said, as always, sir.
I was going to compliment what Phil had said. I think that's where we differentiate also ourselves with the audiences, and I have now started to mention the word risk management a lot more to advisors. So we've moved away from the derivatives, and all we're talking about is risk mitigation. And I think that's where the advisor looks at it and starts to talk to the end user, which is the client as well as the institutions.
Get away from the D word, because that gets them away from gambling connotation and towards, like you said, the hedging risk management aspect, which is really should be focusing their efforts and their interests anyway. Well, gentlemen, thank you for coming on and giving us an update on all things OIC. I think we covered everything. Is there anything else you guys would like to add or feel we left out?
We just want to thank you again for the invaluable service you provide. So thanks for having us, and we look forward to coming back.
I'm glad we can have you back, Phil. I know this time must be nice to actually have it go out to our listeners, so it'll be doubly fun. All right, guys, thanks again for coming on. And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated. All rights reserved.